November 2024. Goldman Sachs puts out a research note. Standard stuff. Equity outlook, sector allocation, the usual. Buried on page 23, there's a single line. Aggregate S&P 500 revenue exposure to China, direct and indirect, estimated at 26%. 26%? More than $1 in every 4 that S&P 500 companies make has China somewhere in the chain. Not just Apple or Tesla, the whole index. Your retirement account, your index fund. 1/4 of it goes through China. Same week, different report. Bank for International Settlements. They track cross-border exposures. The number they publish for Western financial system exposure to Chinese assets, trade credit, and supply chain dependencies, north of $8 trillion. $8 trillion. Now go watch CNBC, read the Wall Street Journal. Listen to what they're saying about China, collapsing property market, shrinking economy, demographic crisis, Xi Jinping losing control. The narrative is China's in decline. Retreat? Irrelevant soon? Those two things can't both be true. If China's economy is collapsing and irrelevant, why does the S&P 500 have 26% revenue exposure? Why is there $8 trillion in financial system dependencies? Why are we still this tied? And if we're this tied and something breaks on their end, what happens on ours? Let me show you the answer, because it's not what you think, and it's already starting. Here's what everyone believes, the story you've heard 100 times. China's weapon is treasuries. They hold $750 billion in US government bonds. If they dump them, interest rates spike, the dollar crashes, markets collapse. That's the fear. It's also wrong, not because China wouldn't do it, but because that's not where the leverage actually is. Treasuries are the distraction. The real weapon is something way bigger, way harder to defend against. And it's not a button they push. It's a system that's already built and running. It's the $8 trillion in exposures that nobody's pricing in. Let me break down what that actually means, because exposure sounds like finance jargon. It's not. It's your money. Start with revenue. S&P 500 companies, the ones your 401k owns, pull in about 26% of their revenue from China-linked activity. That's not just sales to Chinese consumers, it's components made in China, assembly done in China, raw materials sourced through Chinese buyers, supply chains that touch China at some stage. Apple makes 70% of all iPhones in China. Tesla's second biggest market is China. Nvidia sells AI chips to Chinese data centers. Starbucks has 7,000 stores in China. GM sells more cars in China than in the US. When those companies report earnings, the number that determines if your index fund goes up or down is partly based on what happened in China last quarter. Not Washington, not New York, Shenzhen, Shanghai. Beijing, that's the first layer. Second layer, supply chains. Over 40% of global manufacturing passes through China at some point. That's not just final assembly, it's rare earth minerals, lithium processing, semiconductor packaging, active pharmaceutical ingredients, battery cells. You can't make an electric vehicle without Chinese battery supply. You can't make advanced semiconductors without Chinese rare earth magnets. You can't produce half the medications on the market without Chinese chemical precursors. This isn't theory. In 2020, when COVID hit and Chinese factories shut down for 2 months, global supply chains seized. Automakers couldn't get chips, pharma companies couldn't get ingredients, shelves went empty, 2 months, and the system almost broke. Now imagine that disruption isn't a virus. Imagine it's intentional, selective, targeted. Third layer, commodities. China's the largest buyer of oil, copper, iron ore, soybeans, natural gas. When Chinese demand shifts, global prices move. When China slows down, commodity exporters from Australia to Brazil to Canada feel it. And those commodity price moves hit Western markets, energy stocks, materials, industrials. Your diversified portfolio isn't insulated from Chinese demand. It's directly exposed. Fourth layer, and this is the quiet one, trade settlement and financial plumbing. Western banks have extended trillions in trade credit to facilitate commerce with China. Letters of credit, financing for shipments, currency hedges. When a European company buys goods from China, there's usually a Western bank in the middle providing short-term financing. If that flow disrupts, it's not just the companies that suffer, it's the banks. And if the banks take losses on China exposure, that tightens credit everywhere else. Mortgages get harder to get, business loans dry up, it cascades. Add it all up. Corporate revenues, supply chains, commodities, financial plumbing. The total exposure of Western economies to Chinese economic activity isn't $750 billion in treasuries, it's $8 trillion, maybe more. The exact number is hard to pin down because a lot of it's indirect, but the scale is undeniable. And here's the part that should make you uncomfortable. All of that exposure was built during a time when everyone assumed cooperation. Trade would keep growing. Geopolitics wouldn't interfere. China needed the West as much as the West needed China. Mutual dependence meant mutual stability. That assumption is dead. China's been systematically reducing its dependence on Western markets for a decade. They've built domestic supply chains, signed trade deals across Asia, Africa, Latin America, created alternative payment systems, stockpiled commodities, moved manufacturing capability inland where it's harder to blockade. Meanwhile, the West is still deeply structurally dependent on China. We outsourced, we optimized, we built just-in-time supply chains that assume Chinese factories keep running. The dependence is asymmetric now, and asymmetric dependence is leverage. So when you hear China's weapon, forget the treasuries. That's the decoy. The real weapon is already embedded in the system. It's the 26% of S&P 500 revenues, it's the supply chains, it's the commodity demand, it's the trade credit. And the scariest part, they don't have to use it aggressively. They just have to let it tighten, slowly, selectively, in ways that look like normal economic adjustment but compound into systemic stress. Let me show you how that's already happening. December 2023, Apple's stock drops 3% in a single day. No big announcement, no scandal. Just a quiet report from a research firm in China. iPhone sales in China fell 30% year over year. 30% in one quarter. Analysts rushed to explain it. Market saturation, competition from Huawei, normal cyclical stuff. But here's what nobody said out loud. The Chinese government didn't ban iPhones. They didn't have to. They just quietly discouraged government employees and state-owned enterprises from using them. No formal policy, no law, just internal guidance. Don't bring your iPhone to work. Apple didn't lose 30% of sales because the product got worse. They lost it because Beijing turned a dial, not all the way. Just enough to send a message. And Wall Street felt it immediately, because Apple is 7% of the S&P 500. When Apple drops 3%, the whole index moves. Your retirement account moved, mine moved, everyone's moved. That's what selective pressure looks like. Now scale that pattern across industries. January 2024, Tesla reports China sales, down 18% year over year. Elon Musk had been pushing back on some of Biden's China policies. Suddenly, Tesla's facing regulatory scrutiny in China. Quality investigations, safety reviews, nothing that shuts them down, just enough friction to slow things down. Tesla's stock wobbles. The EV sector pulls back. Again, your index fund feels it. Same month. Caterpillar reports earnings. Revenue from China dropped 22%. Construction equipment sales collapsed. Not because Chinese construction stopped. It didn't. Because Chinese buyers started choosing domestic brands. Sany, XCMG, local manufacturers. The shift wasn't random, it was policy. Buy Chinese guidance from provincial governments, procurement rules that favor domestic companies, subsidies that make foreign equipment more expensive. Caterpillar is a Dow component. When they miss earnings, the whole industrial sector reprices. You see the pattern? Beijing isn't doing anything dramatic. They're not seizing assets, not banning companies, just adjusting incentives, redirecting demand, tightening approval processes. Death by 1,000 small cuts, and each cut shows up in corporate earnings, which shows up in stock prices, which shows up in your portfolio, but it gets worse, because the revenue exposure is only part of it. Let me show you the supply chain angle. 2025, there's been quiet talk about restricting gallium and germanium exports from China. These are rare earth elements used in semiconductors, solar panels, defense systems. China controls about 80% of global gallium production and 60% of germanium. In August 2023, they already imposed export controls. Not a ban, just licensing requirements. You want to buy these materials? Apply for a license, wait for approval. Maybe you get it, maybe you don't. Western semiconductor companies panicked quietly. Because you can't make advanced chips without these materials, and there's no alternative supplier at scale. You can't just switch to buying from Australia or Canada. The processing facilities don't exist. China spent 20 years building that capacity. We spent 20 years buying from them because it was cheaper. Now they've got leverage. Same story with lithium processing. China doesn't mine most of the world's lithium. Australia and Chile do, but China processes 70% of it. They take raw lithium and turn it into battery-grade material. Every electric vehicle, every grid storage battery, every laptop. It goes through Chinese processing. If that flow slows down, lithium prices spike. Battery costs go up. EV makers miss production targets. Stock prices adjust. Tesla, Rivian, Ford, GM, all exposed. And it's not just tech and autos, pharmaceuticals. About 80% of the active pharmaceutical ingredients used in US drugs come from China or India, and most of India's pharma inputs come from China. So really, it's China. Antibiotics, blood pressure meds, diabetes treatments, cancer drugs. The supply chain runs through Chinese chemical plants. During COVID, China restricted some pharma exports temporarily, just for a few weeks. US hospitals started running low on critical medications immediately. Now imagine that happens during a geopolitical crisis, not a virus, a deliberate choice. Your medication costs spike, if you can get them at all. That's not theoretical. That's the supply chain we have right now. Here's the number that keeps me up at night. The Bank for International Settlements estimates total Western financial system exposure to China-related assets and trade credit at over $8 trillion. Let me put that in context. US GDP is about $28 trillion. So this exposure is nearly 30% of the entire US economy. It's more than the total value of all US Treasuries held by foreign governments. It's more than the mortgage-backed securities market that nearly collapsed in 2008. And it's spread across everything. Bank loans, trade financing, corporate bonds, equity holdings, derivative contracts tied to Chinese assets or Chinese counterparties. Most people have no idea this exposure exists because it's not in one place. It's distributed across the system. Every bank has a piece, every pension fund has a piece, every insurance company has a piece, and unlike treasuries, which you can sell in liquid markets, a lot of this exposure is illiquid. You can't just dump a supply chain relationship. You can't quickly replace a factory in Shenzhen. You can't exit a joint venture overnight. You're locked in. That's what makes this a weapon. Not that China holds assets they can sell, but that Western markets are structurally dependent on Chinese flows continuing, and those flows are being quietly redirected. Look at what China's been doing with commodities. For the past 3 years, they've been stockpiling copper, oil, soybeans, rare earths. They're buying at a scale that doesn't match their current consumption. Why? Because they're building reserves, so that when they do restrict exports or reduce imports, they've got a buffer. They can handle the disruption. The West hasn't been stockpiling. We've been optimizing for efficiency, just-in-time everything. Minimal inventory, maximum dependence on flows continuing smoothly. We're brittle. They're building resilience. And here's the tell that this is strategic, not accidental. Look at the Belt and Road Initiative. China's been building ports, roads, rail lines across Asia, Africa, and Europe for a decade. Everyone thought it was about expanding Chinese influence. It is. But it's also about creating alternative trade routes that don't depend on Western shipping lanes or Western financial systems. If trade flows with the West slow down, China's got options. They can sell to Pakistan, to Indonesia, to Nigeria, to Kazakhstan. They've been building that infrastructure for years. The West doesn't have that. If Chinese imports slow down, we don't have alternative suppliers ready. It takes years to build new factories, years to develop new supply chains. So you can't just decide on Monday to replace 40% of your manufacturing dependencies. So here's where we are. Western markets are priced as if the China trade relationship is stable and permanent. But the underlying structure is shifting. China's reducing dependence. The West isn't. And every quarterly earnings report gives you another data point. Another company missing numbers because China sales dropped. Another supply chain delay because Chinese exports slowed. Another price spike because Chinese demand shifted. It's happening now, in real time. Just slowly enough that it doesn't feel like a crisis yet. But let me show you what it looks like when it accelerates. March 2025. A semiconductor analyst publishes a report. Dry stuff. Industry data. But there's a table on page 11 that's wild. It shows how many days of inventory US tech companies hold for critical components sourced from China. The average? 23 days, 23 days, less than a month. If the supply from China stops, most companies run out in 3 weeks. Compare that to Chinese companies sourcing from the West. They're holding 90 to 120 days of inventory, 4 months. That gap tells you everything about who's prepared for disruption and who's not. And it's not just semiconductors. It's across the board. Automotive companies, medical device makers, consumer electronics, they all optimize for lean inventory because carrying stock costs money, warehousing, insurance, capital tied up. So they built systems where components arrive just in time, sometimes just hours before they're needed on the assembly line. That works beautifully when everything flows smoothly. It's a disaster when it doesn't. And here's what shifted in the last 2 years. Chinese companies aren't just building domestic alternatives. They're getting good at it. Huawei got cut off from Western chips in 2020. Everyone said they were done. Can't make 5G equipment without cutting-edge semiconductors. Can't compete. By 2024, Huawei's shipping 5G phones with chips made entirely in China. Not as advanced as TSMC's bleeding-edge stuff, but good enough and improving fast. Same story with electric vehicles. 5 years ago, Chinese EV companies were jokes. Cheap knockoffs, low quality. Now, BYD is outselling Tesla in multiple markets. Not because they're cheaper, though they are, because they're actually good. Better battery tech in some cases, better software integration. And they control the whole supply chain. Batteries made in China, motors made in China, software written in China. They're not dependent on anyone. Meanwhile, Western EV makers are dependent on Chinese batteries, Chinese rare earths, Chinese processing. The asymmetry isn't just about current exposure, it's about who can decouple faster if they need to. Let me show you what this looks like in the financial system, because that's where it gets really dangerous. Western banks have extended massive trade credit to support commerce with China. When a US company buys goods from a Chinese supplier, there's usually a letter of credit from a bank guaranteeing payment. The Chinese supplier ships the goods. The US company receives them. The bank pays the supplier and collects from the US company later. That system processes trillions in trade annually. And it works because everyone assumes the trade keeps flowing. But what happens if Chinese suppliers stop accepting letters of credit from Western banks? What if they demand payment upfront, or payment in yuan instead of dollars? Suddenly, US companies need to come up with cash immediately instead of getting 60 or 90 days of financing. That's a liquidity crunch. Companies that were solvent yesterday become stressed today, not because their business model broke, because the financing terms changed. And if enough companies hit that problem simultaneously, you get a credit event. Banks that extended all this trade credit start seeing defaults. They pull back. Other companies that weren't having problems suddenly can't get financing either. It cascades. This isn't hypothetical. We saw a version of it in 2008 with the mortgage market. Not because housing crashed everywhere simultaneously, because the financing structure seized up. Once banks stopped trusting each other's paper, the whole system froze. Chinese authorities understand this. They've studied Western financial crises extensively. They know where the pressure points are, and here's what's quietly changed. Chinese banks are stepping in to provide trade financing in yuan. They're offering better terms than Western banks, not because they're more generous, because it serves a strategic purpose. Every transaction financed in yuan instead of dollars is a transaction that doesn't need the Western banking system. It's another small reduction in dependence. And every company that switches to yuan financing is a company that's now financially tied to Chinese, not Western, institutions. That's leverage being built in real time. Now let me connect this to something you've probably noticed but haven't connected to China. Your grocery bill. It's been brutal the last few years. Eggs, meat, vegetables. Everything's up. Part of that is domestic inflation, but part of it is commodity prices. And commodity prices are heavily influenced by Chinese demand. When China was growing fast and importing massive amounts of food, that pushed global prices up. Now China's slowing down, you'd expect prices to fall. They're not. Why? Because China's buying differently. They're not just buying for consumption, they're stockpiling, building strategic reserves. In 2024, China imported record amounts of soybeans, wheat, and corn. Not because they needed to eat more, because they're filling storage. That keeps global prices elevated, which keeps your grocery bill high. And if China ever decides to stop importing and live off reserves for a while, global agricultural markets collapse. Farmers in Iowa and Kansas lose their biggest customer overnight. Grain prices crash. That sounds good for consumers, except it destroys farming communities. Banks that lent to farmers start seeing defaults. Equipment makers lose sales. The whole rural economy contracts. And your retirement account? It's got exposure to agricultural equipment companies, to banks with farm loan portfolios, to fertilizer companies. When that sector takes a hit, your diversified portfolio feels it. This is what systemic exposure means. It's not just China sells fewer iPhones. It's that every piece of the global economy is connected, and China sits at the center of enough connections that when they shift, the whole web moves. Here's the part that changed how I see all this. For years, the assumption was that economic interdependence made conflict impossible, mutual assured economic destruction. China needs Western consumers. The West needs Chinese production. Nobody benefits from breaking it. That logic made sense when dependence was symmetric. It's not symmetric anymore. China's been methodically building alternatives. Domestic consumption, regional trade, BRICS partnerships. They've got options. The West hasn't built alternatives. We've got deeper dependencies, more concentration, less resilience. And when one side of a relationship has options and the other doesn't, that's not mutual dependence. That's one-sided leverage. The scariest thing? They don't need to use it dramatically. No declarations, no bans, just small adjustments. Redirect some demand, slow some approvals, tighten some export licenses. Each move individually looks minor. Collectively, they add up to Western markets repricing, and the repricing has already started. Look at forward earnings estimates for S&P 500 companies. Analysts have been quietly downgrading China revenue assumptions for 2 years. Not catastrophically, just steady downgrades. 5% here, 8% there. But if 26% of your revenue base shrinks by even 20%, that's a 5% hit to total earnings. And stock prices don't fall 5% when earnings fall 5%. They fall 15% or 20% because valuations compress when growth slows. That's your index fund, your 401k, your retirement. And the adjustment is just beginning. Let me walk you through what this actually looks like in your life. because systemic exposure sounds abstract until it hits your account. Your 401k. Let's say you've got $100,000 in there. Standard retirement account. Maybe you're in a target date fund. Maybe a S&P 500 index. Doesn't matter. You're exposed. Remember that 26% revenue figure? If S&P 500 companies see their China-related revenues drop by 20% over the next few years, that's not a 20% hit to your portfolio. It's worse, because when revenues fall, margins compress. Companies cut costs, lay people off, reduce investment, future growth estimates drop. And when growth estimates drop, price-to-earnings ratios contract. A 5% earnings decline can easily translate to a 15% stock price decline, maybe more. So your 100,000 could be 85,000. Just from this one factor, not a crash, not a single bad day. Just steady repricing as quarterly reports come in weaker than expected, again and again. And you can't just get out, because where do you go? Bonds? They're facing their own problems with rising rates and inflation. Cash? It's getting eaten by inflation. International stocks? Half of them have China exposure too. The diversification you were promised doesn't protect you when the risk is systemic. Now let's talk about your job, because this isn't just about investment portfolios. If you work for any company that sells to businesses, you're downstream of this. When companies see earnings pressure, the first thing they cut is discretionary spending, marketing, consulting, software subscriptions, office expansions. If you're in B2B sales, your targets get harder to hit. If you're in corporate services, clients start asking for discounts. If you're in commercial real estate, vacancy rates go up as companies downsize. You might not work for a company that does business in China. Doesn't matter. You work for a company that does business with companies that do business in China. 3 degrees of separation. And that's close enough for the pain to reach you. Let me show you the supply chain version of this pain. You run a small manufacturing business in the Midwest. You make industrial components, nothing fancy. You source some raw materials from China because they're 40% cheaper than domestic alternatives. Your margins are thin. You're competing with other small manufacturers. You can't just eat a 40% cost increase. So when Chinese export restrictions tighten or shipping costs spike or payment terms change, you've got a choice. Raise prices and lose customers, or keep prices flat and lose money. Either way, you're in trouble. And you can't pivot to domestic suppliers quickly, because those relationships take years to build and the domestic capacity might not even exist anymore. That factory in Ohio that used to make what you need, it closed in 2015. The equipment was sold off. The workers found other jobs. You can't just restart that overnight. So you're stuck. You're dependent. And when that dependency gets stressed, your business becomes unviable. That's not a hypothetical. That's happening to small manufacturers across the country right now. They're just not making headlines because they're going under one at a time. Now let me show you the version that hits everyone, whether you own stocks or run a business or not. Medication. Check your medicine cabinet. Blood pressure pills, cholesterol meds, antibiotics, whatever you take regularly. About 80% chance the active ingredients came from China or India. And India sources most of their pharmaceutical precursors from China. Right now, that supply is stable. Prices are manageable. Your insurance covers it. But if Chinese pharma exports get restricted, whether for political reasons or because they're prioritizing domestic supply, the price of your medication doesn't just go up. It spikes. We saw a preview of this during COVID. Certain antibiotics became scarce. Prices jumped 300% to 500% in a matter of weeks. Not because demand surged, because supply got choked. Imagine that happening across multiple drug categories simultaneously, not temporarily, as a new normal. Your insurance might not cover the new prices. Even if it does, your premiums go up to compensate. Either way, you're paying more for the same pills. And if you're older, if you're on multiple medications, this isn't an inconvenience, it's a crisis. Here's the version that affects your everyday purchases. Electronics, your phone, your laptop, your TV. All of it has components made in China, not just assembled there, critical components that can't easily be sourced elsewhere. If those supply chains tighten, prices go up. And this time, there's no Fed stimulus check coming to offset it. You just pay more. That new phone you were planning to buy, it's $1,400 instead of $1,000. The laptop for your kid's school, it's $1,800 instead of $1,200. Your budget just got squeezed. And so did everyone else's. So consumer spending slows, which means retail earnings fall, which means retail stocks drop, which circles back to your 401k again. Everything's connected. Let me give you the version that hits your community. Commodity prices. If Chinese demand for oil, copper, iron ore, agricultural products shifts, global prices move. Let's say China reduces oil imports because they've been stockpiling and they want to pressure Western economies. Oil prices fall. Sounds good, right? cheaper gas. Except oil-producing states like Texas, North Dakota, Alaska, they see tax revenues collapse, state budgets get cut, public services get reduced. If you live in one of those states, you feel it directly. Or flip it. China increases commodity purchases, driving prices up. Now gas is $6 a gallon. Your heating bill doubles. Inflation spikes again. Your paycheck buys less. Either direction, volatility controlled by decisions made in Beijing, not Washington. And here's the thing that keeps coming back to me. All of this exposure was built when everyone assumed cooperation, when we thought trade made conflict irrational. But rational assumptions break down when interests diverge. China's interest is reducing dependence on the West, becoming self-sufficient, building regional dominance. They've been working toward that for 2 decades. The West's interest was cheap goods and corporate profits. We optimized for that. We didn't optimize for resilience. Now the interests have diverged, and we're holding the bag. Your retirement account is exposed. Your job is exposed. Your supply chains are exposed. Your medication supply is exposed. Your community's economy is exposed. And unlike 2008, where the problem was contained to financial markets and could theoretically be fixed with bailouts and Fed intervention, this is structural. The Fed can't print supply chains. Congress can't legislate pharmaceutical ingredients into existence. The problem is real economy, not just financial economy. Here's what that means practically. If earnings miss because of China exposure, the Fed can't fix it with rate cuts. If supply chains seize up, stimulus checks don't help. If medications become scarce, monetary policy is irrelevant. The tools that worked in past crises don't work for this one, and the adjustment is already underway. Quietly, in earnings reports, in supply chain delays, in rising input costs that aren't making headlines but are showing up in corporate filings. Most people won't notice until it's obvious. Until their 401k statement shows a number that's significantly lower, until their company announces layoffs, until their medication gets expensive. By then, the repricing will be done. The question is whether you see it coming early enough to adjust. Not to avoid it, you can't avoid systemic risk, but to understand it, to position for it, to not be blindsided when the obvious becomes undeniable. So let me bring this back to where we started. Goldman Sachs, page 23, one line. S&P 500 revenue exposure to China, 26%. Bank for International Settlements, $8 trillion in systemic exposure. 2 numbers that don't fit the narrative you're hearing, that China's collapsing, that they're irrelevant, that we've moved on. Because if they were irrelevant, your retirement account wouldn't be tied to their quarterly consumption data. Your supply chains wouldn't run through their factories. Your medication wouldn't depend on their chemical plants. The exposure is real, the dependence is asymmetric, and the adjustment is already happening. Not through dramatic announcements, through quarterly earnings misses, through supply chain friction, through slowly tightening export controls and shifting commodity flows. Apple down 30% in China sales, Tesla down 18%, Caterpillar down 22%. Each one individually looks like a company-specific problem. Zoom out, and it's a pattern, and now you can see it. When the next earnings season comes, and another wave of companies misses because China revenue's disappointed, you won't be surprised. You'll recognize it. When another semiconductor company announces delays because of rare earth supply constraints, you'll know why. When commodity prices swing and analysts can't quite explain it, you'll understand it's Chinese demand shifting, not market fundamentals. You've got the framework now. The $8 trillion isn't a number anymore. It's your portfolio exposure, your supply chain vulnerability, your medication dependency. It's the structure underneath markets that everyone's treating as stable, but is actually repricing in real time. And here's what matters going forward. This doesn't resolve cleanly. There's no policy fix that makes 40% of global manufacturing suddenly relocate. There's no Fed intervention that rebuilds domestic supply chains overnight. There's no deal that makes the asymmetric dependence symmetric again. The adjustment takes years, maybe a decade. And during that adjustment, volatility isn't a bug, it's the feature. Your index fund isn't going to smoothly compound at 8% a year while this plays out. It's going to swing. Because every quarter brings new data about how fast the exposure is repricing. The companies that adapt survive. The ones that don't, their stock prices tell the story. And your job is simple. Not to panic, not to sell everything, just to understand what you're actually exposed to. That retirement account you thought was diversified, it's concentrated in companies with China dependencies. Know that? That stable job in a sector that seems insulated? Trace the connections. Your clients' clients might have exposure. Know that too. Those everyday products you buy without thinking. The prices aren't just about domestic inflation. They're about supply chains and commodity flows influenced by decisions made in Beijing. Know it. Most people are going to figure this out the slow way. Through their account statements, through price shocks, through surprises that shouldn't be surprising if they were paying attention. You're not most people anymore. You see the $8 trillion. You understand what it means. And when the repricing accelerates, you won't be asking what happened. You'll already know.